You planned a smart Roth conversion. You moved money out of your traditional IRA, paid the tax, and felt good about the decision. Then your Medicare bill arrived, and it was hundreds of dollars higher than you expected. That's not a billing error. That's IRMAA. And for 2026, the income thresholds have shifted in a way that catches a lot of people off guard. Here's the number that should get your attention. According to the Centers for Medicare and Medicaid Services, the standard Medicare Part B premium for 2025 is $185 per month. But if your income crosses the first IRMAA threshold, that premium jumps to $259 per month. For a married couple, that's nearly $1,800 more per year, from a single income event you may have already forgotten about. In this video, we're going to walk through exactly how IRMAA works, where the 2026 thresholds are expected to land, and how to run the math before you convert so you don't accidentally hand Medicare a bigger check than the IRS. What IRMAA actually is, IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge on top of your standard Medicare Part B and Part D premiums. The Social Security Administration calculates it every year using your tax return from 2 years earlier. That 2-year lag is the detail that trips up almost everyone doing Roth conversions. The program was created by the Medicare Modernization Act of 2003 and was originally aimed at the highest earners. In the early years, only about 4% of Medicare beneficiaries paid any IRMAA surcharge at all. But the income thresholds were not inflation adjusted for years, so more and more retirees got pulled in over time, a phenomenon sometimes called bracket creep. Congress finally required annual inflation indexing starting with the 2000 benefit year, which helped at the margins but didn't eliminate the trap. Here's why this matters specifically for Roth conversions. A Roth conversion is a taxable event. The amount you convert gets added to your adjusted gross income for the year. If that spike pushes your MAGI, your modified adjusted gross income, over an IRMAA threshold, Social Security sends you a notice about 2 years later saying your Medicare premiums are going up. The conversion is long done. The money is sitting in your Roth, but now you're paying for it through Medicare. This is not a niche edge case. The Tax Policy Center has estimated that Roth conversions are one of the most common triggers for unexpected IRMAA surcharges among retirees between age 63 and 72. And the people most likely to be doing large conversions are exactly the late starters in the 55 to 65 window who are trying to accelerate their tax-free savings, the 2026 IRMAA thresholds. And why 2024? Income is the number that matters. The 2026 Medicare premiums are determined by your 2024 tax return. That's the look-back rule in action. If you made a large Roth conversion in 2024, even back in January of 2024, that income is what Social Security will use to set your 2026 premiums. The official 2026 thresholds have not been finalized by CMS as of this script, but the 2025 thresholds are public record, and the 2026 figures are projected to adjust modestly for inflation. Here is what the 2025 structure looks like according to CMS, and this is the framework that will carry forward with small adjustments into 2026. For individuals filing single, the first IRMAA tier begins at MAGI above $106,000. For married filing jointly, it starts at $212,000. At that first tier, Part B goes from $185 to $259 per month per person. At the second tier, $133,000 for individuals, $266,000 for joint filers, it rises to $370 per month. The third tier, $167,000 individual and $334,000 joint, puts the premium at $480 per month. There is a fourth tier above $200,000 individual and $400,000 joint at $591 per month. And the top tier, which kicks in above $500,000 for individuals and $750,000 for joint filers, reaches $628.90 per month. Now add the Part D surcharge on top of that. According to CMS, the IRMAA add-on for Part D at the first tier is $13.70 per month in 2025. At the top tier, it's $85.80 per month. These are per-person charges, and they stack onto whatever your Part D plan premium already is. Your filing status changes the math significantly. A single filer doing a $100,000 Roth conversion who starts the year with $80,000 in Social Security, pension, and investment income is sitting at $180,000 MAGI, well into the second IRMAA tier. A married couple with the same combined income and a $100,000 conversion is at $180,000 MAGI, which is still below their first threshold. Same conversion, dramatically different outcome. Running the conversion math before you act. Here's what I'd do before executing any Roth conversion if you're on Medicare or within 2 years of enrolling. Run a MAGI projection for the conversion year first, then look at each IRMAA tier as a cliff you either stay below or intentionally clear. Let me walk through a concrete example end to end. Take a 64-year-old single filer. She has Social Security income of $24,000. She has a required minimum distribution, not triggered yet at 64, but she has a part-time consulting income of $18,000. Her investment income adds another $12,000. Her starting MAGI before any conversion is $54,000. She wants to convert as much of her traditional IRA as possible before she hits Medicare at 65. If she converts $50,000, her MAGI becomes $104,000. That is just under the $106,000 individual threshold for the first IRMAA tier. She pays standard Part B premiums, $185 per month, when she enrolls at 65. The conversion tax bill at her marginal rate is real, but there's no Medicare surcharge. If she converts $55,000, her MAGI becomes $109,000. She has crossed the first IRMAA tier by $3,000. Her Part B premium jumps to $259 per month, an extra $74 per month, or $888 per year. That $5,000 extra conversion generated an $888 annual Medicare penalty, and the penalty lasts the full year. There's no way to undo it after the fact. Now, run this forward. If her Roth grows tax-free and she avoids future required minimum distributions, the math may still favor the conversion. The point is not that you should never cross an IRMAA threshold. The point is that you should know you're crossing it before you do, not discover it when your Medicare notice arrives 18 months later. A $3,000 accidental overshoot that costs $888 per year for 1 year is very different from a deliberate strategy to convert aggressively and absorb the surcharge because the long-term tax-free growth justifies it. My take, convert up to the IRMAA cliff deliberately, or clear it deliberately. Never drift over it by accident. The look-back trap and the year. Most people get wrong. The single most common mistake I see in this space is people conflating the conversion year with the Medicare year. They convert in 2024, they go on Medicare in 2025, and they assume they're fine. They are for 2025. But Social Security will review their 2024 return to set their 2026 premiums, and that's when the surcharge hits. This means if you are 63 or 64 right now, every income decision you make this year has a 2-year shadow. A large Roth conversion, a business asset sale, a property sale, a large capital gain distribution from a mutual fund, all of it lands on your Medicare bill 2 years from now. According to the Social Security Administration, they use MAGI from your most recently filed federal tax return. If your 2024 return isn't available yet when they calculate your 2026 premium, they fall back to 2023. This can actually work in your favor if you had a high-income year in 2023, but a lower year in 2024. You can file an appeal to get the more recent return used, but it can also work against you if your conversion year is the most recent filed return on record. There is an additional wrinkle for people who are still working and converting simultaneously. If you're 58 and doing partial Roth conversions now, those won't affect your Medicare premiums at all. You won't enroll for another 7 years, and the look-back only reaches 2 years. But once you're inside that 2-year window before Medicare enrollment, every conversion decision carries this extra cost layer. When to appeal, and how it actually works. Here's where most people leave money on the table. IRMAA is not always permanent. The Social Security Administration allows you to appeal a surcharge if you experienced a qualifying life-changing event that reduced your income since the base year they used. According to the SSA, qualifying events include retirement, reduction in work hours, divorce, death of a spouse, loss of income-producing property, and an employer settlement payment. Notably, a one-time Roth conversion that you won't repeat is not on that list. If the high income was from a conversion and your income genuinely dropped in subsequent years, you cannot appeal on the basis of the conversion itself. But you can file Form SSA 44 and ask them to use a more recent tax year if a qualifying event changed your income picture. The practical application for late starters: if you retired in 2024 and your income dropped sharply, but Social Security is still using your high-income 2022 return to set your 2024 premiums, you can appeal with documentation of your retirement. The SSA processes these appeals at the local field office level, and approval rates are high when the qualifying event is clearly documented. What most people get wrong about the appeal process is the timeline. You have to file while the surcharge is active, not years later. If you receive an IRMAA determination notice, you have 60 days to request a hearing. Missing that window means paying the surcharge for the full year, even if you would have qualified for relief. My take here is clear. If you receive an IRMAA notice and you have experienced any income reduction since the base year, file the appeal immediately. The form is 2 pages. The cost of not filing is real money. Sizing the conversion the right way. The practical framework I'd use, and this is how I'd approach the math for anyone in the 60 to 72 window, is to build what tax planners call a Roth conversion budget that has 3 inputs: your current MAGA before any conversion, the IRMAA tier cliffs for your filing status, and your marginal income tax rate. You work from the lowest IRMAA tier upward. First, fill the space between your current MAGI and your income tax bracket ceiling without crossing an IRMAA cliff. Then decide whether the next tier is worth deliberately crossing given the surcharge cost versus the long-term Roth benefit. Sometimes it is. A 62-year-old with a $400,000 IRA, no pension, and low current income may find that converting aggressively at a 12% or 22% marginal rate, even while paying the first IRMAA tier, beats the alternative of paying 32% or 37% on required minimum distributions at 73 when Social Security is also in the income stack. According to Vanguard research on Roth conversion strategies, the break-even period for a conversion depends heavily on the tax rate differential between the conversion year and the expected withdrawal years. If your tax rate is the same both years, the math is roughly a wash, and the main benefit is estate planning and RMD reduction. If your rate today is meaningfully lower, which it often is for recent retirees in the first few years before Social Security and RMDs stack up, the conversion math tends to favor acting sooner. The IRMAA cost is a real drag on that math, but it is a 1-year drag per conversion year. If a $30,000 IRMAA surcharge costs you $1,800 in extra Medicare premiums that year, you're looking for the Roth to earn back that $1,800 in avoided future taxes. For most people with a long-time horizon and meaningful IRA balances, that's a low bar. The problem is only when people convert without knowing they crossed the cliff at all, because then they didn't account for the drag and they can't re-optimize around it. I cover catch-up retirement strategy for late starters, and this is the kind of detail that separates a good conversion plan from an expensive one. Running these numbers once before you act costs you nothing. Skipping them can cost you thousands. Before you go. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video helped you see the IRMAA picture more clearly, hit subscribe so you don't miss the next one. And I'd genuinely like to know what retirement planning questions are on your mind right now. Drop your question in the comments and I'll work the best ones into upcoming videos. There may also be a link below to a tool that can help you model these conversion scenarios. Check the description for details. This video may contain affiliate links. I only recommend tools I use personally.